Welcome to our conversation on financial reporting. In this session, we'll try to understand the business decisions and financial statements with a focus on inventory accounting. As a result, the relevant accounting standard that we'll be using in this presentation is Ind AS 2. So inventory as defined in Ind AS 2 includes those goods which are held for sale in the ordinary course of business or are in the process of production for such sale or in the form of material or supplies to be consumed in the production process or in rendering the services. So it clearly conveys a message that Ind AS 2 is not meant for property, plant equipment, or intangible assets which are not held for sale, or investments which are not held for sale. And moreover, there are different accounting standards or separate accounting standards for PPE, intangibles, and investments. So when we get into the Ind AS 2, there are important issues that need to be observed, that it talks about the measurement of inventory at the time of purchase, at the time of use, and at the end of the accounting period. Ind AS 2 deals with the measurement of inventory at the time of purchase, at the time of use, and at the time of end of the accounting period. At the time of purchase, it's the cost of acquisition. Ind AS 2 will tell us about the cost of acquisition. And cost of acquisition of the inventory bought at that time is an asset because it is unexpired benefit will appear on the balance sheet. But when the inventories are sold or used for production, then it becomes cost of goods sold and it becomes an expense. At the end of the accounting period, inventory purchase minus inventory use is the cost of unsold stock is an asset. So this process of asset becoming an expense, an unexpired item becoming an expired item, then accordingly, the treatment will have the impact on the balance sheet or income statement. Ind AS 2 is not concerned about the financing of inventory, whether you are using the existing cash or buying through the issue of shares or buying through the issue of other non-equity instruments or by using any other assets which are there in the balance sheet. So let us pick up the first one, a cost of acquisition. So cost of acquisition, according to the standard, consists of three important parts. One is the cost of purchase or purchase price, plus the conversion cost, plus the incidental expenses or other expenses which are required to bring this inventory to the working condition. So at the time of acquisition of inventory, the inventory should be recorded and reported at cost of purchase, that is a purchase price, plus the conversion cost, plus incidental expenses. The purchase price or the cost of purchase consists of the price that we have agreed to pay to the supplier, the import duties and other taxes. But remember, the taxes other than those are recoverable. So non-recoverable taxes will be included. Any other transportation, handling, other costs directly attributable to the acquisition of finished goods, material, or services. Or trade discounts, rebates, if someone receives, that should be deducted while computing the cost of purchase. The conversion cost is generally meant for those manufacturing unit. It includes the cost directly related to the units of production, such as direct labor, They're also included on a systematic allocation of the overheads, fixed overhead and variable overhead. But see that these are expenses. By including these expenses in the cost of inventory, we are actually treating that as a part of the asset. Though when the asset is used, it becomes an expense. But so these expenses are capitalized or included into the cost of the material. And incidental costs or other costs are those which are included in the cost of inventory only to the extent that they are incurred in bringing the inventory to the present location. So there is a judgment there whether you want to include or not. If it is not included, they will straight go to the income statement. If it is included, then it will become the part of the inventory. Ind AS 2 also talks about, very clearly says the following costs cannot be included in the cost of inventory. The abnormal amount of wasted material, labor, or other production. If there is abnormal losses, in principle, that is not allowed to affect the cost. It will be shown as a separate line item. Storage cost, unless those costs are necessary for the production process. Administrative overhead that do not contribute to the bringing inventory to the present location. And of course, the selling cost. But even in this case, other than the selling cost, there is a possibility that if you can prove that they are required to bring the asset to the working condition, maybe there is a possibility of including that in the cost of inventory. So that is about the cost of acquisition. Now let us see at the time of the use. When the inventory is purchased, they will appear on the balance sheet as asset. When inventory is sold, they become the cost of goods sold. It becomes an expense and is shown in the income statement because of the matching principle. Now, cost of goods sold, they say that when inventory is sold, the carrying amount of those inventories shall be recognized as an expense in the period which the related revenue is recognized. We can see the application of matching principle. When the goods are sold, sales is compared with the corresponding cost of goods sold, matching principle, to derive profit. But the amount of this depends on the methods of inventory valuation. So whether the company uses FIFO, I mean the first in, first out, where the opening inventory is disposed of first, or whether you use a weighted average cost of the firm cost, or whether you use the standard cost, or specific identification, or retail cost, retail price method. Now, these methods observed are actually to fit into the nature of different types of businesses. So, if the business gives you the indication that it's possible to identify the goods which have been sold, then we'll follow a specific identification. When it is not possible to identify a large number of material, different sources, different locations, then in that case, the standard cost method is used. So the accounting standard in AS 2 for that matter gives the opportunity, gives the freedom to the management or the company to select the relevant and appropriate method. With the change in the method, we'll see how it affects the cost of goods sold. As a result, it affects the bottom line or the profit. Then we'll get into the inventory at the time of the preparation of the balance sheet. At the end of the accounting period, the cost of the unsold stock is equal to opening stock plus the goods purchased minus the cost of goods sold is the cost of unsold stock, which is an asset. The Ind AS 2 says that inventory shall be measured at the cost or the net realizable value, whichever is lower. And this can be explained through the conservative principle, okay? So if the market value or the net realizable value is lower than the cost value, then it is necessary to bring down the value of the unsold stock to the net realizable value. And to calculate this net realizable value and as well as comparing it, the recommendation is that item by item can be compared. Each item's cost value, NRV, whichever is lower. Item 2, cost value, NRV, whichever is lower. Or sometime, in some circumstances, if it is not possible to identify like that, the entire group of materials can be clubbed together and market value can be compared with the cost value, and whichever is lower will be recorded. But you may ask, what will happen to that difference if the market value is lower than the cost value? If the market value is lower than the cost value, the amount of any write down, that means a reduction in the value of the inventory, and other incidental losses shall be recognized in the income statement as an expense. And this is a classic case of conservative principle, anticipated losses, because this is unrealized loss. It's only fluctuations in the market. That loss should be shown in the income statement as a separate line item. So, in principle, cost or the market value or cost or the net realizable value, whichever is lower, is shown on the balance sheet. And the amount of, suppose in the next year, if the market value of the inventory goes up, if the market value is lower than the cost value, we show market value and book the loss in the income statement. But in the subsequent period, if the market value goes up, the accounting standard gives a very clear instruction. The amount of any reversal of any written down inventory arising from the increase in the net realizable value shall be recognized as reduction in the amount of inventories which has been recognized and expenses in the previous period. That means to that extent, the cost will be adjusted. It's a gain. In the previous period, it was shown as a loss, but it will be reversal of the loss. We'll not call it a gain, but reversal of the loss only to the extent of the loss. And this will become clear when you do a numerical exercise. The accounting standard, not only Ind AS 2, every accounting standard also very clearly prescribes the disclosure in the annual report. The disclosure, the Ind AS 2 says the financial statement must disclose the following: the accounting policies adopted in measuring the inventories, the total carrying amount of the inventory, the carrying amount of inventories which are carried at the lower than the market value, the amount of inventories recognized as an expense, in other words, COGS, the amount of any written down, a write down of inventory, which has been shown as an expense. Don't club it with other items. Show it as a separate line item. The amount of any reversal in the subsequent year, if there is a reversal, if the market value goes up, then the amount of that. These are disclosures to be made in the financial statement. So to understand inventory, to understand the cost of goods sold, and to understand the cost of unsold stock, understand the measurement principle and understand the impact of the measurement principles on profit, on cash, on equity, in other words, on the financial statements. So let us take an example, a simple example, a numerical example to understand the principles. But here we will take only one method called FIFO. A very simple exercise has been given. but we are preparing the financial statements, all the four financial statements as mentioned in Ind AS 1, balance sheet, income statement, cash flow statement, and the statement of changes in equity. And there are very few transactions given here related to inventory because our focus is to understand inventory. But it's always good practice, at least from the exam's point of view. In real world, of course, there will always be notes given, but for the purpose of examination, it's a good habit to have a working note when any calculations are required to be done. So here we are having a working note for inventory calculation, the COGS calculation, the and the closing stock calculation. The impact of these three will be visible in the financial statements. So there is an opening stock. There's an opening stock of goods in the at the value of 8 rupees. So the value of the inventory is 68,000, which is visible in the balance sheet. Now the company is following FIFO because they have three different purchases within 1 month. So for the first purchase, the amount purchase is 2,500. The amount purchase is 2,500 and the price at which it is purchased, let me just adjust that. The price that is used to buy that is 9 rupees. You can see that 9 rupees. So the value of that inventory purchase is 22,500. 22,500. And that has been purchased for cash. So let us see the impact on financial statement. When you purchase the stock for 22,000 for cash, the stock will go up to the extent of 22,500. The stock will go up to the extent of 22,500 because it has been purchased. The next one has been purchased at 6,500 at 12, and this time it has been purchased on credit. So there is a creditor 78,000. As a result, the inventory will increase to that extent. Can we see the inventory once again? Inventory, we can see the inventory was 68,000. Was 68,000. Now the inventory is 168,000. So acquisition of inventory resulted in decrease in cash and increase in creditors. Now let us see the third purchase. The third purchase is 6,000. Third purchase is 4,000. 4,000 units. 4,000 units. Okay. And the price is 15. So the value is equal to 60,000. But this has been purchased for shares, not par issue of, not for credit or not for cash. So the increase, so there is an issue of shares to that extent. Issue of shares. So increase in the stock because of acquisition, and acquisition has happened by issuing shares. So the value of shares will increase to that extent, but it will go through the statement of changes in equity. So can we observe the inventory working note? The inventory working note is we have purchased so much stock, we had stock, so 21,500 and at different prices. So this much is the 168,000. So 168,000 will be the amount of inventory before the sales happen. We can see that 228, 228. Now the company is sold 2,000, 15,000. How much stock is there? 21,000. So let us see the value of COGS by using FIFO. Since it is FIFO, the first in, first out. First we sell it from the opening stock. So the corresponding value is equal to 8,500 into 8. The calculation of this component is next one is from the second lot of purchase. The value of that is equal to the value of the goods sold. Cost of goods sold is 22,000. Then the balance 4,000 is from the 12, okay, from the inventory which is there in the 12. So the corresponding cost of goods sold, is 138,000. The amount of goods sold, the quantity of goods sold is 15,000. So COGS to that extent will be shown in the income statement because of the matching principle. But because there is a COGS has come down, the inventory will reduce to the extent of the goods sold. We can see that inventory available is 90,000. Purchases minus COGS is the inventory, which we have also seen here also, 90,000. Okay. Now let us assume there are no other expenses. Okay. So the entire goods which have been sold is for cash. Let us assume that it is for cash. The corresponding cost of goods sold is 138. So therefore, PBT is equal to 371. Let us assume that the tax is 25% on this. And also, let us pay the tax. These are assumptions. If you don't want to pay, create a liability. Then comes the PBT minus tax is PAT. And PAT, what to do with the PAT? Transfer the PAT to the statement of changes in equity. So the entire PAT goes to the statement of changes in equity. There is no dividend, there is no buyback, so the entire other equity will be transferred to the balance sheet, okay, to the balance sheet because that is the retained profit available. So in this example, other equity only includes retained profit. No premium, no OCIs, so it is only the profit, not distributed. So income statement is done. Let us find cash in hand. Cash in hand is equal to cash available minus the cash expenses. So cash available, cash in hand is 444,000. Cash in hand is receipts minus payments. Receipts minus payments. We can see that that's an asset transfer. Other equity comes from the statement of changes in equity and cash comes from the cash flow statement. The total of sources, okay, if we are not wrong, should be same. A is equal to E plus L. A is 534,000 and E is equal to capital plus other equity and L is a creditors. So in this example, through this example, we have seen two things. One is the Ind AS 2, which explains about the measurement of inventory and the measurement of COGS. And Ind AS 1, which shows the template for the financial statements, balance sheet, income statement, cash flow statement, and the statement of changes in equity. So this is a one of the methods of inventory management or inventory reporting is FIFO. In the subsequent classes, we'll change the method, or in other words, examine the impact of other methods, weighted average, specific identification, standard cost, retail price methods, and see the effect on the financial statements. So, the entire purpose is to understand this. The inventory at the time of purchase, inventory at the time of use, and inventory at the time of preparing the balance sheet. Measurement of asset, measurement of expense, and measurement of the unsold stock, which is also an asset. Thank you very much.